Hello, my name is Nini Florence Mansal. Today, our group will present about the firm capital structure, theory and practical perspective. But before we go furthermore, let me explain you what is actually the terms of capital structure. The concept of structure refers to the way of the various parts are arranged. As a result, capital structure encompasses the management of assets from a variety of sources in order to raise the firm's long-term capital requirements. Capital structure also refers to the organization use of a mix of debt and equity to fund its whole operations and growth. Did you know that capital structure decisions also play an important role to the organization? Let me tell you. First of all, capital structure decisions may help to increase revenue and profits if the firm is able to sell goods or services to the client. When it keeps going on, the capital structure of the firm will increase the accessible finance. A solid capital structure will help a firm to fully utilize its available capital to ensure that corporation become much stronger for a long time period. Secondly, capital structure decisions also have the potential to lower the financial risk that been faced by every company. Financial risk, as we all know, is the danger of losing money on an investment. It is a sort of risk that might result in the loss of capital to those who are interested in making an investment. However, by balancing the amount of debt and equity in the business through a capital structure, it will aid in the risk management and reductions in their business ventures. Thus, a capital structure decisions also have a vital role in lowering the firm's cost of capital. But if the firm has an excessive cost of capital, it can be damaging to the organization because the firm has not enough capital to cover all the expenses that incur. So, all of it depends to the firms on how they manage to use their capital structure decisions. Now we move to the sample of listed company. Since our group decided to choose Samdabi Berhad, we need to know what the firm is and how the firm has link with the capital structure. Samdabi is a Malaysian corporation who operating in plantation, industrial equipment, automobile, real estate and energy. Samdabi is a diversified international corporation with over 50,000 employees that operating in 23 countries. It plays an important role to the Malaysian economy since they are a multinational company. As you know, their plantation segment is the world's largest producer of palm oil, accounting for around 2.47 million metric tons yearly. Here is the balance sheet of Samdabi Berhad. As we can see, the group balance sheet was significantly altered as a result of the poor play exercise. Samdabi Berhad have a strong financial positions by the end of the 2020 with a debt to equity ratio of 20%, down from 32% in the first year of 2019. This gives the groups considerable debt headrooms to fund and future expansions plan. As for the review of the capital structure, it has a few theories that also play a significant role for every firm, which is the Modigliani-Miller theorem, trade-off theory, pecking order theory, and signaling hypothesis theory. However, I will let my friend, which is Joanna Lisa, to elaborate this theory with more details.
Hello, my name is Joanna Lisa. Today I'm going to present about the specific capital theory. Firstly, it's about the Modigliani and Miller theory with taxes. First of all, the Modigliani and Miller theory is an ideal scenario that does not apply in the real world. As a result, Modigliani and Miller has made a various modification in order to make it more practical in the real world. The assumptions of the newer version implies that company pay taxes, there are transactions, bankruptcy, agency costs, and information is not theoretical. In the propositions 1 of Modigliani-Miller theory with taxes, it states that tax shields that result from the tax-deductible interest payment make the value of levered company higher than the value of unlevered company. The main rationale behind the theorem is that tax-deductible interest payment positively affect a company cash flow. In the second proposition for the real-world condition states that cost of equity has directly proportional relationship with the leverage level. Nonetheless, the presence of tax shields affect the relationship by making the cost of equity less sensitive to the leverage level. Moving to the agency cost of equity theory, This was developed by Johnson and Maclean that suggests that an ideal capital mix exists. The terms of agency costs refer to the disagreement between shareholders and firm manager, as well as the expenses incurred to address this agreement and maintain a harmonious relationship. Johnson and Maclean distinguish two kinds of conflicts. The first conflict is conflicts of interest between manager and stockholders. Conflicts between shareholders and managers emerge because managers do not own the entire residual claims. Thus, they do not reap the full benefits of their profits in enhancing operations, but they incur the whole cost of these actions. The other conflicts are conflicts of interest among debt and equity investors. Conflicts between debt holders and equity holders emerge because the debt contract provides an incentive for equity holders to invest efficiently. Lastly, I'm going to be talking about the pecking order theory. This theory is related to a company capital structure made popular by Stuart Mice and Nicholas Majlut in 1984. The theory states that managers follow a hierarchy when considering sources of financing. This pecking order theory simply states that the order financing should be sought. Number 1, retained earnings. Number 2, debt. And number 3 is equity financing. Retained earnings is the first order in the pecking order theory because there is no additional cost. If the company chooses retained earnings as the first option, it may signal to the market that the company is strong because it relies on its own funding. This is also good as it bring value to the shares of the company. The order number 2 is debt financings. This may signal to the market that the company is confident in meeting its borrowing obligations. It has to pay interest, but interest tax is deductible. Finally, it is the equity financings. It's ranked as the last options in the pecking order theory. Well, this is more expensive because the equity owner takes the highest risk. This may signal to the market that the company cannot fund itself and may have cash flow issues. This may also mean that the share price is overvalued. So, that's all about the specific capital theories. Thank you.
Lastly, I will present about the signaling hypothesis theory. The behavior of leveraging personal information to establish a trading situation is known as signaling. It happens when an insider exposes critical information about a company, causing people who do not normally have insider information to purchase or sell the company's value. Outsiders regard the insider's activities to be a market signal. Based on the following signaling hypothesis theory, there are 4 components involved in the process of signaling theoretical concept, which includes signaler and receiver, as well as the signal itself and the feedback. Information asymmetry is the concept in signaling theory, and it is based on the assumption that information is not openly applicable to all individuals at the same time. Next, I will present about the optimal capital structure. The general concept of maximizing a firm's value by using a low cost of capital is essential to the optimal capital structure. The existence of an optimal or adequate capital structure for a corporation can be recognized when the cost of capital or weighted average cost is lowest and the firm's value is at its peak. Various types of businesses will have various capital structures that work well for them. The importance of management in the capital structure of the organization has been recognized and maintained in daily business operations. Despite this, no theory has yet been able to properly explain for the formation of optimal capital structure. When it comes to determining a firm's optimal capital structure, finance managers frequently face difficulties. Any poor financial decision can have a significant impact on either a company's financial difficulty or, in the worst case scenario, bankruptcy. By analyzing the varied levels of debt and equity in a capital structure of the firm, managers can utilize several particular techniques to enhance the firm's performance. Optimal capital structure refers to any optimum combination of debt and equity that will give a lower weighted average cost of capital.
The lower the cost of capital, the higher the WACC discounted present value of the firm's future cash flows. As a result, the primary purpose of any company financial department here is to determine the best capital structure that will result in the lowest WACC and highest business value shareholder wealth. Further, I will present about the factors affecting capital structure decisions. In the current ever-changing business environment, poor decision-making by senior management has resulted in massive losses for major corporations. There are many factors affecting capital structure decisions of the companies, especially affecting debt and equity ratio, such as taxes, types of assets, and uncertainty of operating income. For taxes, a high corporation taxes as well as high dividend and personal income taxes have a direct impact on capital structure decisions. And for types of assets, a companies with more tangible assets should have lower leverage ratio. The ratio of net fixed assets to total assets is known as tangibility. And the third factors affecting capital structure decision is uncertainty of operating income. Profitability and leverage should have a positive relationship according to trade-off theory. Operating income divided by total assets is how profitability is measured. Hence, based on the three important factors affecting debt and equity ratio, which are taxes, types of assets, and operating income, shows that the company needs to practice a good risk management as a key decision-making tool in order to continue operating as an ongoing entity and achieve the ideal financial capital structure decisions.
Assalamualaikum and hello, I am Sani Sansi and let's move to financial distress and its relation to a firm's capital structure. Firstly, what is financial distress? It is a situation when a company unable to generate sufficient income to pay its obligation or debts. Generally, financial difficulty can cause a company to default on a contract and require financial restructuring between the company, its creditor, and its equity investor. Concept of financial distress can be linked with insolvency. Black's Law Dictionary described the insolvency as the inability to pay one's debt. As such circumstance of whether the assets and liabilities of a woman's or man's that the former made instantly accessible would be inadequate to discharge the latter. There are two categories, which is stock and flows, distinguished by Edward Altman. First, stock-based insolvency happens when a company has a negative net worth, which means that the value of its asset is less than the value of its debt. Flow-based insolvency, however, arises when operational cash flow is insufficient to satisfy its existing obligations. Insolvency may result firms towards bankruptcy. Next, I move to integration of tax effects and financial distress costs. Cost of financial distress divided by two, which is direct costs include legal and administrative costs, whereas indirect costs include the loss of customers, suppliers, and great staff. The ultimate distress is bankruptcy cost because it can lower the firm's value. The tax effects and financial distress costs include value of firms, which referring to the marketable claims. Normally, financial manager will choose a capital structure which maximizes the value of marketable claims and minimizes the value of non-marketable claims. The value of levered firms are higher than the value of unlevered firms. According to Montigany and Miller's tax propositions, a corporation will borrow since the interest tax sale is valuable and the presence of corporation tax allows debt to increase a firm's value. When the present value of financial distress cost grows, so does the present value of debt tax shield. This is the connection between the two. Last but not least is corporate finance decisions on capital structure decision in the real world. To conclude, identify the best capital structure to fund a company is a core part of its financial management. Capital structure indeed is important on deciding the corporate finance decision because the firms relies on their capital structure to minimize their overall cost of capital and maximize the value of the firms to effectively achieve their goals. To ensure overall health of the company, a balanced capital structure is essential. An ideal capital structure will minimize the cost of capital by lowering cost of equity or include more debt on the capital structure, reduce business-related risks because it is important to ensure the company can cover their debts, and lastly, maximize the value of the firms with the combination of debt to equity.